Tom Lee just dropped a bombshell prediction for the S&P 500 over the next 3 weeks or so. He also dropped a big prediction for Bitcoin. If you are in crypto, you definitely want to hear this as well.
June is going to, well, I'm going to introduce you, and then I'm going to let him tell you, because we're not going to bury the lead on this. Let's get to Tom Lee. Fundstrat, he's pretty amazing guy that we try to visit with as much as we can. He's on kind of a roll. He is managing partner and head of research at Fundstrat Global Advisors, also a CNBC contributor. And once again, you're doing exactly what I tell you not to do, Tom, and that is giving a price target and a time frame. Never do both. Never do one or the other, but you're doing it again. So 5,500 on the S&P by the end of June. It's hard not to talk about that immediately. Based on, Tom, lower inflation.
That's right. I think there's a fundamental case, Joe, which is inflation is coming in softer than expected, and I think the job market is it's cooling but not weakening dramatically, and I think that's a good situation for equities. And I think that the sell-off in April actually hasn't really been fully recovered. And that's why we expected a rebound in May, but I think that carries over into June. And there's still $6 trillion of cash on the sidelines, and margin debt's still way below where it was in October 2021. So we know investors really aren't that long yet. So I think that comes together this month with a pretty surprisingly robust move higher.
It is a little bit longer than that crazy call you made. It was based on a week, Tom. I remember, and it worked out for you. You were right. So now at least you're doing it in terms of a month. In the past, when you have made these calls, it's been about inflation, hasn't it? And that's where it is again. What are you seeing in terms of components that make you confident that those were outliers that we saw a couple months ago, where it looked like it was inflation was coming back?
Yeah, the April inflation data, both CPI and PCE, kind of revealed that the two things that the Fed's been waiting to cool are starting to cool. One is shelter inflation. You know, it's decelerating, even though it's still higher than the Fed would like. And then I think there's some evidence that auto insurance, which has been rising over 22%, is beginning to sort of normalize. And I think sometime before the second half, auto insurance is no longer going to be contributing to inflation. So that's the dynamic we think that's at play in this upcoming May CPI report. That comes out May 12th.
The other lead I didn't want to bury, and this is another crazy call, Tom. 150,000 on Bitcoin by the end of the year. It's already June.
Yes. We're still constructive on Bitcoin. There's the tailwinds that are associated with the halving that just took place. We also know because of the Bitcoin ETF, and there have been tremendous inflows, but institutional sort of adoption and infrastructure being built around Bitcoin is only beginning. And that makes, crypto, especially Bitcoin, a bona fide asset class. And I think that sort of widening ownership is going to be propelling Bitcoin to 150,000. And again, maybe surprising or not surprising, Bitcoin still follows math. More than 87% of the move in Bitcoin still follows just the number of wallets and the activity per wallet, and both are moving higher.
Tom, I would think that a lot of your calls are based on the Fed cutting too. Bitcoin's not going to 150 if the Fed doesn't cut. So you must think that the Fed is going to be able to cut. Is that because of inflation? Is it because the economy slows? Fundamentally, what do you think has to happen for all these bullish things in both stocks and crypto to happen with the Fed?
I think it is important for the Fed to not have hikes on the table. So I think that's the most important for investors, is the Fed is no longer in a rate hiking cycle. But if the Fed makes even just one cut this year, I think it's really supportive of equities, because it really shows the Fed is trying to sort of nurture the business cycle, and it's a good environment for stocks. I don't think one cut or three cuts makes that much difference for stocks, but again, you're exactly right. It all depends on inflation. Really, the edge coming off enough for the Fed to say we're comfortable cutting this year,
but not necessarily. We could have Goldilocks. We could have inflation come down and the economy continue to do okay.
Yeah, that's right. I mean, I think the company's earnings have actually really spoken to how in a 5% pretty restrictive rate environment, earnings have been really robust. I know consumers, there are some trouble signs out there, but consumer leverage is still quite low. And of course, if the Fed does begin to cut, there's a lot of levers that will boost both consumer wealth and company demand. So I think there's still positive catalysts that are associated with a Fed cut eventually.
All right, Tom Lee, not much more that needs to be said. We'll be able to, that's just way too specific, but we'll have you on and we'll check July, maybe we'll have you on July 1st, see what's going on. We won't be mad if you're not exactly right, because you're willing to go out on a limb all the time with us, so we appreciate it.
That is a very aggressive near-term call for the S&P 500. That would actually be a gain of about 4.1%. Well, I guess closer to about 4% actually, to get right to about 550 on the S&P by the end of June. That's basically saying that all of your data this week, all of your data throughout really the month of June is going to solidify. The Fed should start to cut rates soon, and the economy is doing just fine. Now, how does that happen? Well, you have to see the data for the economy come in okay. It doesn't have to be red hot, but it can't be too bad at the same time, or Wall Street will start to focus on whether or not we could go into a potential recession. On the other hand, you have to see all of your inflationary data come in better than expected. I don't even think meeting expectations would be nearly good enough to get markets to 550 in the next 3 trading weeks. We did actually see something quite troubling today. IWM, this is the ETF for small cap stocks, was down over 1%, at least it is at the time of recording this video, when you actually had weaker than expected JOLTS job opening numbers that came out this morning. JOLTS job openings came in at 8.05 million. Last month, you were revised lower from 8.48 million down to 8.35 million. The expected number was about 8.34 million. So what happened? You actually missed by about 300,000 job openings. That should have been seen as maybe a positive to get rate cuts sooner. And the markets did assign a higher chance of your first cut now coming July 31st. Last week, you did have a probability of 12.2% of your first cut July 31st. Yesterday, it was 15.5%. And now today, you're at 17.8% odds. And they keep jumping from 17, 18% chance or so to about 20% chance or so. So in that range is kind of where you've been sitting for the entirety of the day today. So odds are rising that you get the first cut July 31st, but the sector that should benefit from that the most, the small caps, is actually selling off because of it. Now, why would small caps sell off even though the economic data has started to point towards cuts coming sooner? Well, small caps stand to lose the most if we do go into a recession, which I find fascinating because for years now, weaker than expected economic data has been seen as a positive for this area of the markets, and it seems like that is no longer the case. It seems like now the markets just want to see inflation coming down, and the economy getting worse is actually going to be a bad thing for stocks. You can see your other indexes like the NASDAQ is up 0.25%. The S&P's up roughly 0.25%. The Dow Jones Industrial Average is up 0.5%. And again, the Russell 2000 is down about 1%. Even though your other major indexes are slightly in the green today, the VIX is actually up 1.22%. That means there's more puts being bought today then calls. Now, coming tomorrow, you will have very important data. This is probably the most important data of this week, besides the non-farm payrolls report on Friday. You are going to get the ISM Services PMI. You're expecting a number around 50.5. Last month, you were at 49.4. So the headline number, if it meets expectations, comes in a little bit hot, it doesn't matter as much. What will matter the most is ISM Services prices. Now, last month, prices came in at 59.2. Now the estimate is around 60. So you're actually expecting prices for services are going to go up, or did go up for the month of May. If those come in lower than 60, and specifically lower than last month's number of 59.2, that is probably what is going to dictate whether or not tomorrow is a good day for small caps and or a good day for the broader markets. Here you can see today 10-year treasury yields are down about 6.5 basis points. So again, to my point, that normally should have had a positive impact to your small cap stocks, and it did not today. So just assuming that Tom Lee is correct and the S&P can hit 5,500 by June, that would imply a pretty aggressive rally could be coming for small caps as well. Now, here on the day today, IWM is trying to find support around that 50-day moving average. You're currently under that just a little bit, but the day's not over with. And I would imagine, at least if this end of the day rally continues for the S&P, the Russell is probably going to get above that 50-day moving average as well. So I would consider today is probably going to be an okay day on a technical basis. Now, you are still above your 100-day moving average. You're below your 20-day moving average. So that's not exactly great, but I think right now it's all about the 50-day moving average. Now, as well as that, the RSI is at 46.86 and the MACD is curling down, and the MACD line is at 0.52. The signal line's at 1.03. So getting closer and closer to actually going negative. You have also seen oil decline quite a bit in the last couple of days. Yesterday down 4%. Today down another 1%. The day before that down 1%. The day before that down 1.3%. And even the day before that down about 1.4%. You have seen oil fall quite a bit, from $78 a barrel down to $71 a barrel in just the last, 4 or 5 trading days or so. That should be good for your disinflationary kind of pressures to come over the next couple of months. Oil touches everything, and when oil rises, typically inflation rises. When oil falls, typically inflation also falls. But oil falling can be a sign that economic demand, economic activity might be slowing down as well, because you need less oil if people are not doing as much. So I think on a day like today, when you're seeing what's happening out there to small caps on, better news about the economy slowing down, I think Tom Lee's really making a bold call here and sticking his neck out on the line. And whether he's right or wrong, you really gotta respect that. A lot of people are too afraid to do that. And, to be honest, if the S&P rallies 4% in the next 3-4 weeks, then that probably means small caps could rally 10% or so. I think that would be the obvious expectation, as long as rate cuts are expected to come and inflation does decelerate. Maybe Tom Lee knows something that we do not. I don't know, but a 10% rally from here would put IWM at about 223. Today it's at 202. If you were to see a 2x move and small caps rally about 8%, that would put IWM to about 219. Is that possible? Of course, but even a 7% or 6% move for that matter would put IWM at about 215. Is that possible? Again, of course that's possible. But at this point, you need the economy to continue to do okay and inflation pressures come down. We did get good news yesterday with ISM manufacturing prices paid. Those did come down. And PCE was also good on Friday, right? You've had good news on inflation. It has not translated into small caps doing well. And I believe that's because there are fears that maybe we are heading into a recession, which will be bad for small caps most importantly. And you can even see here, just market wide today, it's pretty rough. The percent of stocks above their 50-day moving average is at 44.63%. So 44.63% of all stocks out there are above their 50-day moving average. 5.2% of all stocks are falling under their 50-day moving average today alone. That's a pretty rough day. We do also have some earnings today in after hours with CrowdStrike, Hewlett Packard, PVH, Stitch Fix, Guidewire, Sportsman Warehouse, Verint, and Lakeland Industries. Tomorrow pre-market, Dollar Tree, Ollie's, and Campbell's. A lot of the markets are probably going to be watching Dollar Tree as well as CrowdStrike and even PVH to see like how that more luxury brand is doing right now, if the consumer's slowing down from that as well. Same is true with Lululemon. You also have ChargePoint, Victoria's Secret, Five Below. Thursday pre-market, you have Neo, Cena, Big Lots, Toro, JM Smucker, ABM, SecureWorks, and others. And then Thursday and after hours, you have DocuSign, Samsara, Rent the Runway, and Braze, as well as Vail Resorts. So do me a quick favor, let me know what you think about Tom Lee's bold prediction, jaw-dropping prediction. I mean, that's a huge call for really no time. Right? That's a very speculative trade if you were to put that on, let's say, in the options market for the S&P 500. So let me know your thoughts on that down below in the comment section. Hit the like button as well as subscribe to the channel on your way out of this video. Thank you for watching. Enjoy your day, and I will see you in the next one.